Welcome back to another episode of Palisade Radio. This is your host, Collin. On the line with me today, a good friend of mine, Matt Geiger. He's the fund manager at MJG Capital. Matt, welcome back to the program.
Hey, thanks for having me back, Collin. Hope you're doing well in this weird world we're currently living in.
Certainly weird, but hard to not be doing well as a junior gold bug or investor.
That much is true.
At this point in time. So we're recording this on Thursday, May 7th, and one day never really means much, but it just feels like a bull market, and it's a good feeling. So I guess a good place to start. What's your overall feeling like at the moment?
Well, I mean, I'm still cautious, Collin. This sharp bounce we've seen from the broader markets, I think, has caught everybody by surprise. I'm still operating under the base assumption that the broader markets will retest those lows that we saw in mid-March. Seems like a world away at this point, but just to remind listeners, I was only 7 weeks ago when we were seeing that broad-based panic selling. I think it's more likely than not for the broader markets to retest or break lower. If you look at historic bear markets, that occurs 60 to 70% of the time. But every bear market's different. Obviously, the Fed's unprecedented policy response here is an added variable that could make this time different. I think if we do see a retest of those lows, how it happens will be key for those of us with precious metal equity exposure. And I would much prefer a long, more drawn out kind of March lower than another 2 or 3 weeks of panic like we saw in early March. But obviously the market does not care about my preference, and we're hanging in there. We'll see how it plays out. Have a decent cash position now of around 10-12% in the fund, which may not sound like all too much to your listeners, but for a fund that's usually fully deployed, trying to remain a little bit cautious here because I do think there'll be more turbulence ahead.
Yeah, you bring up a point that's probably on the minds of a lot of gold investors, which is, as a gold investor, we don't place much credence in the validity of this recovery in the overall market. It doesn't seem to make sense. The economy is bad. Unemployment's bad. It's hard to imagine things just going back to normal. So it seems like it's going to be prolonged and slow, and yet you've got the stock market has recovered quite a bit. I guess the one good thing is gold stocks are breaking out to new highs and the stock market hasn't. But what happens if the stock market does start to tank again? That's probably something you're chewing on quite a bit.
Sure. Well, that's a $64,000 question right there. And I think to your point, kind of the best quote I've heard is from Howard Marks in one of his recent missives. And he said quite simply that, stock markets are only down 10% from their all-time highs, but the world is clearly more than 10% messed up. In fact, far more than 10% messed up than it was just 90 days ago. So that kind of anchors my belief that this kind of V-shaped recovery does seem too good to be true. Again, I think with precious metal equities, you have to keep in mind these are risk assets. Even gold in its own right, when you have panic sell-offs like we saw in early March, that is used for liquidity first and foremost. So I do think if we have another panic event, you should expect some sharp weakness amongst gold equities and maybe even the spot price of gold. That said, the carnage might not be as dramatic. But I think investors have learned just from this experience in March that while there's immediate pain, gold snaps back quickly. And I think with that anecdote, so recently in mind, this next waterfall sell-off, if we have one, will hopefully be a little less painful for us precious metal investors. But still, I have to caution listeners to hold enough cash where it gives you the confidence not to panic sell if we have another one of those March-like events in the coming months.
Matt, what's your feeling on how this all is going to play out for various metals? Gold and silver is one narrative that I think most of our listeners can get behind and understand why they probably will do well. Uranium's another one we've discussed a bit, and it's obviously had some positive benefit from what's going on. How about the rest of the metals? There's a lot of them.
I should start with the caveat that I am a bottom-up investor. And so while I do have views on which metals, which companies will likely perform in this environment, I want to make it clear that we're not saying, oh, we're all in uranium and buying a big basket of uranium juniors. I think that the key to this game is to be extremely selective with who you align yourself with and which assets you align yourself with. So I'm still sticking to that game plan as I always have. That said, I do obviously have views on kind of the immediate future of the market. And I do think you touched on the two biggest and most obvious beneficiaries of this post-COVID world we're living in. I think the two yellow metals are the most obvious place to be. And I think a lot of commodity investors, late March, after you saw the panic selling start to potentially subside, started to run a thought experiment. And they're thinking to themselves, across the board, we're having supply cuts for each and every metal, for each and every commodity. Most of those supply cuts were COVID related. Also, some of them just due to prices being too low and supply having to come offline. So we're seeing supply cuts across the board. The issue for most of the commodity complex is that as these supply cuts are happening, you're seeing a commensurate amount of demand destruction as well. Because obviously with everybody sitting at home, unemployment across the world moving into the 20 and 30% range, we're going to see reduced consumption and reduced demand over this upcoming period. And so I think the reason that the two yellow metals, gold and uranium, are standing out here is that investors have recognized that specifically for these two metals, we're not seeing that commensurate drop in demand. And that's what's particularly unique about them. For gold, it's pretty obvious. I mean, 93% of gold, last I checked, demand either went into coins, bullion, or jewelry. So only 7% of gold demand is industrial. Even in an extreme scenario, if that were to drop to zero and there was no more gold industrial demand, I think the increase in investment demand for a safe haven asset in times of uncertainty and volatility like we have now will far more than compensate for that 7% drop. So I don't think it's controversial to say that in this environment we should see gold demand increase at a time where, again, supplies come offline rather sharply in the past 60 days. We'll see it start to come back online, but that's not a simple process. Uranium, it's similar. I don't necessarily think we're going to see a sharp demand increase for uranium like we may with gold. But the key to keep in mind with uranium that these contracting cycles are long. These utilities are thinking 2, 3, 4 years ahead in terms of the uranium that they have to procure. And more importantly, even if we do see a sharp decrease in electricity demand in the coming 12 months, 18 months, pick your time frame. The key to remember is that turn off these nuclear plants. You really can't. So utilities will turn off each and every one of their coal and gas-fired power plants before they even consider turning off a nuclear plant. It's expensive, it's dangerous, it takes labor, it takes a lot of time. If you turn off a nuclear plant, you're decommissioning it. You're not going to turn it back on in a year or two when electricity demand comes back. So long story short, I think in a worst case scenario, you're going to see uranium demand stay largely flat. And this is in an environment, as I mentioned, where we've seen close to half of global supply come offline in a very short amount of time. So I think for those two reasons, you're seeing those two metals and the associated equities perform very well in this environment. You mentioned silver. I'm a little more cautious on silver. We do have 70%, 75% of silver demand is industrial. So I think you could see a bigger hit there than some silver bulls are anticipating. Obviously, the silver to gold ratio is blown out, so that's partially being reflected in the price. I'm a longer-term silver bull over a 3, 4, 5-year time horizon. I think investors with exposure to the metal are going to be doing quite well over the next 9 months. Will gold's outperformance of silver continue? I'd say probably. PGM's in a similar camp. I think 90% of PGM demand is going to catalytic converters. So that's another precious metal or metal that's viewed as a precious metal that might underperform in the near term. Yeah, and then I'd say the rest of the industrial commodities complex It's not worth going through each metal one by one, but just broadly, the question is how much demand destruction are we going to see relative to the supply cuts? And for each metal, it may be different, but as a whole, it's the environment's turned decidedly negative, I'd say, on much of the industrial and bulk material complex, at least in the short term.
Perfect. Well, always a thorough answer. I've got a question I want to ask you about a specific part of the mining business, one that you've been a huge proponent of for quite some time, which has been a good thing in the bear market for sure. That's been the royalty business. I think most of our listeners are familiar with how the royalty business works. Feel free to go over that. But, you and I have both noticed there's been a whole bunch of junior royalty companies coming to market, and there's only so many royalties out there to be had. So what do you see playing out in that space?
Well, that's a good observation, and just a phenomenon I've seen probably over the past 3 to 4 months. It started to crop up in late 2019. And there are quite a few upstart private royalty cos that are looking to list and go public in one means or another in the coming months. As an investor who is quite partial to this business model, I'm a big fan of the royalty business model. It does make me a little bit nervous, at least in terms of the precious metal royalty space. And it does seem potentially a bit frothy to me. I would say that the good news is that I've talked with most of the management teams from these upstart companies, and the quality of management team is still relatively high, I would say, particularly compared to your average junior. So that's good. You're not seeing, anybody and everybody with the shell suddenly rolling into the royalty space. We're not at that stage yet, and hopefully we never get there. But just as you mentioned in your question, the royalty space is small. And the fact remains that the more competition there is, really all the royalty companies lose because of that. And the winners are ultimately the producing miners. So as competition increases, deal terms are going to get worse and worse for the royalty companies. They'll be getting lower and lower IRRs. Whereas for the mining, operating mining cos, royalty financing will become an increasingly attractive form for those that need to access capital. So I would say, at least amongst the PM names, the royalty names will lose because of the surge of interest. We're not at red alert yet by any means. I think royalty names are a very smart place to be over these next few years, and most investors would benefit from a good chunk of their mining exposure coming to this business model. It's definitely something that caught my eye and caused a little bit of concern. That said, and I've mentioned this on previous interviews, I still believe that the best opportunity for those of us looking at the royalty business model is amongst the base metal royalty players. And I say this for a few reasons. First is that there's simply less competition for deals, much less competition for deals. As you know, amongst the precious metal space, the royalty business model has revolutionized the industry over the past 15 to 20 years. And if you look at the combined market caps of all gold companies out there, about 20-25% of that is comprised of royalty cos. So it's really changed the landscape. You're not seeing that in the base metal space at all. If you look at the weighted market caps of all base metal players out there, it's about 98% miners, only 2% royalty cos. So I think that's something that will come, but I think it's lagging behind the precious metal name. So less competition. That also means there's less competition for investor interest, less competition for deals, less competition for investor interest. It's also simply more contrarian in this environment. A lot of people are looking towards precious metals and gold in particular. I think if you can buy the higher quality base metal royalty cos when copper and zinc and associated bulk metals are out of favor, timing looks interesting. And then I just say finally that the base metal players have markedly lower price to cash flow multiples than their precious metal peers. And I think that's a mispricing that's going to take some time, but will eventually correct. Because I think you can make an argument that, if anything, the base metal companies should be receiving higher multiples than their precious metal peers. And that's because the average mine life of your average base metal project is much, much longer than your 10 to 15 year gold mine. So I'm not predicting that we'll see the base metal multiples expand beyond precious metal levels anytime soon. But I think there's an argument to be made that the current discrepancy is far too extreme. I think that's an opportunity for investors with patience to exploit.
Matt, you've always looked at private placements as a good way to deploy capital, the benefit sometimes of discounts to market, certainly getting warrant exposure just gives you and your investors a big leg up. And most investors, professional investors, if you will, in the space are certainly investing via private placements. Question to you, have you seen much of a change in the marketplace in terms of buyers and sellers being being the company commanding terms, or the terms changing, et cetera? I'm curious just to see what you've been seeing out there.
Sure. Well, as you can imagine, deal volume dried up in late February through the end of March. And so there were hardly any companies coming to market for good reason. Now that this kind of relief rally is in process, and we'll see how long it lasts, I think companies are smartly using this opportunity to do what they can to cash up, especially if there's more volatility and more pain ahead. So we have deals popping up left and right. I'm sure you've been very busy evaluating them, as I have. I would say generally that, in this environment, the precious metal and the uranium cos, I would say the companies have levered over investors at the moment. And so that's one of the negatives of somebody who does like participating in private placements. I think most of the uranium and or precious metal companies that are worth their salt at all will be able to raise money right now with no warrants attached at all, or maybe a half 2-year warrant, which isn't nearly as appealing as a full 3 to 5 year warrant. So I think if you're looking for incredible deal terms, the gold and uranium place probably isn't where you want to be looking right now, because again, any team with a decent asset and or competent management is probably able to raise on pretty good terms right now. So I'd say in those areas, always focus on quality. I do think there's a window here for kind of the rest of the commodity complex. I don't think it's imminent, but I think whether it's late this year, early next year, if we're still sitting around $2 copper or $5 nickel or, sub $1 zinc, I can guarantee there's going to be some really good deals out there with high quality base metal focused companies that are focused on these out of favor commodities, and who in early 2019 you would struggle to imagine having to raise a financing with a full 3-year warrant attached or what have you. I think those times are ahead of us. So, I would be very cautious as an investor chasing any of these gold or uranium placements at the moment. Make sure to pick your spots and preserve capital for the potential wave of higher quality base metal companies having to refinance. Most of the good companies have runway, but that runway is not infinite. So if you can outlast them as an investor, you can get on board with some really good teams at really good prices. And I'll just say to round out this point, I will add that this is speculation. Obviously, if this beast recovery is the real thing, and by the end of this year we see broader markets at all-time highs and base metal prices perk up further, then this opportunity won't unfold. But I think chances are it will, and so it's something that I'm seeing some powder dry for later down the line.
All right. Well, Matt, thanks for coming back on the program. Before I let you go, anybody who's interested in getting in touch with Matt, your website is mjgcapital.com. And look, if you're interested in participating in the private placement space and you don't have the time or know how to do it yourself, a lot of people have found Matt to be the way to the trade. So, Matt, thanks for coming back on the program.
Hey, thanks for having me, Collin. As you mentioned, always happy to chat with your listeners, whether it's questions about the fund in particular, any of our investments. Always happy to have a dialogue. So, hey, thanks again for having me on the program. We'll talk soon.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?